Hey everyone! Today I want to address covered calls. There are many advantages to selling covered calls, while the only negative, if you want to call it that, is the stock getting taken away if it trades up high enough so the call is in the money. This is actually a best-case scenario, because if the stock gets called away, the trade has reached its max profit, which is what any experienced trader would be pulling for. However, those who are new to option trading might look at this and think they could have made even more money if they never sold the call to begin with. And on a single case basis, that might be true. But over time, selling upside calls against stock is going to totally outperform not selling any covered call. Novice traders are often upset that they get the stock called away from them, even though they still made a great return on their investment. This is the wrong attitude to have. And for those who want their stock back after it gets called away, I'm going to demonstrate how to not only get it back, but to get paid to take it back. But before we get to that, let me first cover exactly what it is I am talking about so we're all on the same page. Let's say we own 100 shares of XYZ stock, which is trading $50. We decide we want to try to make some extra money. So we decide to sell a 55 strike price call for a price of $1.50 that extends out 2 months. In this scenario, let's say the stock trades up to $59 and our stock gets called away. Here we made money on the stock all the way to $55, so we made $5 on the stock, and then we made $1.50 on the option. So in total, we made $650 times 100 shares for a total return of $650. Certainly a quality return. However, if we never sold the call option, we would have not capped out return at $55, and we would have made money all the way up to $59. So in this case, we would have profited $9 times 100 shares for a total return of $900. Clearly, we would have made more by not selling the call. But we only do better with the stock by itself if it trades over $56.50. Which is likely not going to be the case the majority of the time. If the stock just trades sideways, we can continue to make money by selling the covered call month after month after month. And in the long run, this strategy will outperform the profit we missed out on in this rare circumstance. For example, if the stock just traded up to 52 over the next 2 months, both the stock and the covered call strategy would make $2 on the stock movement. But the call seller would also have made another $1.50 on the sale of the call. Here, our stock trader would have made $200 in profit, while our covered call strategy trader would have made $200 plus $150 for a total profit of $350. Clearly, a much higher return on capital. Let's go back to our original example where the stock traded up to $59, and in this scenario, we're going to be the covered call seller. If you remember in the beginning of this video, I told you I would explain how to get the stock back if it was called away. What we can do now is sell one XYZ 55 put for a price of $2. There are 3 different ways this strategy can play out. First, the stock can trade back under 55. Here, we will be forced to buy the stock at 55, which is the exact price we sold it for on the previous trade. Not only do we have the stock back at the price we were forced to sell it at, but we collected a nice premium from the short call and the short put. So we're in a far better position versus if we just bought the stock without adding any options to the position. Another possible situation is the stock trades down, but not under 55. Here, we get to keep that $200 premium, and now we can sell the 55 put again, collecting an even bigger premium than before. If it holds around this level, we can continue to do this month after month. The last situation is the stock continues to trade higher. In this case, there's not a lot we can do here, but at least we got paid $200 to watch it trade higher. I am happy to watch any stock trade higher if I get a paycheck to do it. The point is, all of these scenarios are winners. Some are bigger winners than others, but they're all winners. And getting wins, no matter how big or small, is the key to option trading. If we get caught up trying to get the absolute maximum return on every trade, we will soon be regretting that decision. There's always going to be a better price. So don't get caught up in trying to scrape a couple more nickels out of the trade in exchange for risking dollars. Let's give ourselves the best chance to win over and over again, which will almost always outperform the gambler who's always risking everything in an attempt to squeeze a little more out of a trade. A smart way to get started with this for long-term success is to sell upside calls against stock that we already own and understand we won even if we would have been better off by not selling the call. All right, everyone. I hope you found this video helpful. Remember to stop by our website at optionstrategiesinsider.com and pick up your free option trading course.